everyone and welcome to our YouTube channel. Today it's my honor to introduce Maurice Obstfeld, a renowned figure in economics. Maurice, along with Kenneth Rogoff, developed the new Open Economy Macroeconomics framework, which has deeply influenced our understanding of open economies and multi-country models. His work has been integral to both academic research and practical policy applications, shaping how economists and policymakers approach global economic challenges. In this video, Maury discusses the equilibrium real interest rate, addressing the forces driving it downward over time and exploring the implications of these trends. He provides a detailed analysis of how these factors impact economic stability and growth, offering valuable insights into navigating the complex dynamics of today's global economy. Maurice's expertise and deep understanding make this a must-watch video for anyone interested in contemporary economic issues. Additionally, make sure to check out our connected video where we discuss whether we are on the brink of another global financial crisis. In that video, we explore potential triggers for a recession, including high debt levels in major economies and the implications of the upcoming US elections. Our panel of experts, including well-known economists such as Douglas Laxton, Charles Goodhart, and Eddie Brander, provide unparalleled insights into these pressing issues. Thank you for joining us today. Sit back, relax, and let's welcome Maurice Obstfeld.
It's a pleasure to be here at the summer school of the Central Bank of Armenia. I retired from Berkeley last year, so I don't get to talk to students much anymore. So it's great to have a chance to do that. And the topic I want to explore today is the natural or neutral rate of interest. I'm going to distinguish between them, as you'll see, but it's a central topic in economic analysis and in monetary policy. Okay, let me just see if I can, there we go. So we've just emerged from a period of very high inflation. Things look to be normalizing, but central banks worldwide are still asking how restrictive monetary policy is now, whether it's done enough, whether it's time to ease, and different central banks are finding different answers. Of course, if one is insufficiently restrictive, inflation may rise or be prolonged, but a policy that is too restrictive could lead to a big recession. The key benchmark we use for measuring restrictiveness, both in policy discussions and in some of our models, is something that we label R star. And my message today is that R star is useful, but it's very hard to measure, and it's also a partial guide to policy. It has many drivers, and in formulating policy, we need to think about the future of those drivers and how they might affect R star going forward. Given the central banks use the interest rate as a policy instrument, it's natural to seek a benchmark level at which policy is neither too restrictive nor too accommodative. And in fact, we've seen this come out in the discourse of central bankers. Claudio Borio has surveyed the sharp rise in the number of central bank speeches mentioning the natural or the neutral interest rate. But operationalizing this concept for policy purposes is difficult, and there are limits that have to be thought about before proceeding on the basis of any one R star number. What do I want to talk about today? Um, I'll mention some policy hazards that lie ahead. I'll talk about the history of our star. I'll distinguish between the neutral and the natural real rates of interest, talk about some of the pitfalls for monetary policy, uh, go into why real interest rates have fallen over recent decades, and then talk a little bit about the future of real interest rates and the policy implications. My slides are probably longer than what I can cover in detail, but I'll be happy to make them available to the summer school after the presentation so that you can look in more detail if you would like. Okay, so let me start with the hazards. While some central banks are now cutting interest rates, the debate in others, notably in the United States, is whether inflation will easily descend over this last mile to reach the policy target. Right now, inflation in the US is, depending on how you measure it, might be around 3%, 2% is the target. There are difficulties here for the central banker because uh, if markets anticipate rate cuts, this loosens financial conditions. So just today in the US, a relatively favorable inflation report came out with a relatively small fall in inflation. But markets have assumed this means more interest rate cuts for the US and sooner. This in itself is stimulative and could easily dissipate the progress on inflation. So there are difficulties of the interaction between data, policy, and market anticipations. There could be lagged wage effects. And as was just alluded to, high private and public debts raise issues of high interest rates getting us into a realm of instability. If we look at the recent inflationary history, it's quite interesting because emerging markets have avoided crises by and large. Not true of some lower income countries, but by and large for middle income emerging markets. And monetary policies there have been quite skillful. Now emerging markets are beginning to cut. The Central Bank of Armenia did its first rate cut in June of 2023. And some advanced economies, Switzerland, Sweden, the Euro area, Canada, have joined in. If US rates remain higher for longer, though, what is the prospect for emerging markets? A lot of the answers depend on R star. So let me talk a little bit about the concept of R star, where it comes from, what it means. R star is very often identified as or the concept of the natural rate of interest with the Swedish economist Knut Wicksell, who's shown in the upper right-hand corner. Michael Woodford, in his classic treatise from 2 decades ago on monetary policy, showed how R star could be rationalized within a context of the new Keynesian model. But the first mention of the concept actually is from Henry Thornton, who lived from 1760 to 1815. He wrote an incredible treatise on monetary policy in about 1802. And throughout his career, he focused on the idea that the setting of the central bank policy rate in relationship to the market rate of interest, the rate at which commercial actors were willing to borrow and lend, would be a key determinant of whether the central bank was issuing too much currency or too little currency, i.e., whether policy was inflationary or deflationary. You might ask how this was all relevant under the gold standard. Well, actually, when Thornton wrote, uh, Britain was off gold. It had suspended convertibility during the Napoleonic Wars. So what Thornton's book was about is basically the determination of prices in a fiat currency system. So it's a very modern analysis. And Thornton had some amazing insights. Closely related is the Taylor rule. Uh, uh, you all know what this looks like, and I've written it down here. But you'll notice that there's an intercept in the Taylor rule, which is R star, the natural rate of interest. If there are only demand shocks, so that there is a divine coincidence between output and inflation stabilization, the Taylor rule is unambiguous in recommending pure inflation stabilization. But if there are supply shocks, as we have recently seen, policy becomes more complex and more troublesome. John Williams, an economist who taught at Harvard in the early part of the 20th century, well understood the difficulty of determining R star, or what was the neutral stance of monetary policy. And he has this oft quoted passage, which I've reproduced here, which is worth keeping in mind. The natural rate is an abstraction. Like faith, it can only be seen by its works. One can only say that if the bank policy succeeds in stabilizing prices, the bank rate must have been brought in line with the natural rate. But if it does not, it must not have been. So this is a seemingly tautological, but also, I think, very profound statement of our uncertainty, and also of how we might go about trying to empirically determine our star by looking at the relationship between policy rates and inflation. And that's what a lot of the recent literature actually does. Channeling Williams, Jay Powell, in September of 2023, made this statement, which is very similar, which is that you know sufficiently restrictive only when you see it. You can't arrive at it with confidence in a model or in various estimates. So that's two very sophisticated, but I think accurate assessments of the difficulties of determining the natural rate. Well, there have been many empirical approaches that economists have taken. And I'll show you some of these estimates. Not surprisingly, they don't always agree, and they can give very divergent ideas of where the neutral rate should be. Some authors estimate long-run forecasts by non-structural time series methods. Now, what are they doing here? To understand why this might be an approach that someone takes, you really have to go back to Woodford's book. And what Woodford formalized is that in some settings, you can think of R star as the equilibrium real rate of interest in an economy with no nominal rigidities, where full employment of resources always holds. if that's your view, then you might take the approach in one that we expect that in the long run, nominal rigidities have gone away. So if we look at long run forecasts or trends in real interest rates, that's going to be the natural rate. Another way of going about this would be to look at a term structure model of interest rates. And if you have a structural model of the term premium, and basically the expectations theory of the term structure holds up to a term premium, then you can extract the expected long-run real interest rate. This is a more structural approach than the VAR approach, for example. You can also, sort of go all out Woodford and solve a flexible price equilibrium model calibrated to an actual economy. You take a DSGE model or an OG model and solve for the flexible price equilibrium and take that to be R star. And then one of the most influential approaches is pioneered by Laubach and Williams. This is John C. Williams, not the John H. Williams, who I mentioned earlier. John C. is president of the New York Fed currently. And this approach is very much related to the statements that I showed you from John H. Williams and from Jay Powell. Basically, it's semi-structural. It's basically a Keynesian framework in which you look at the relationship between the policy rate and inflation empirically and extract from that basically what R star must have been. And there are hybrids of all these approaches. Now, if you look at these different estimates, I find it useful to distinguish between two different concepts that I'll call R bar and R star. R bar is the flexible price equilibrium short run rate of interest. R star is the real interest rate at which monetary policy switches from accommodating to neutral as you raise the policy rate. Now, in some theoretical models, R bar is the right benchmark rate for a central bank. It is the neutral rate. And in some DSGE models, guiding monetary policy by R bar compares favorably with the Taylor rule. But these two concepts may differ, and the methods of measurement that I've described actually measure different concepts. The VAR approach is trying to get at R bar by assuming that in the long run, the economy returns to flexible prices, but also that not much else happens in the long run. But in doing so, they abstract from relevant short-run factors that may affect the neutral rate of interest, the rate at which policy switches from accommodative to restrictive. I'll give some examples later of why this is the case, but it may be that currently the economy has an unsustainable external or fiscal deficit. If that's the case, we would expect the neutral rate, the non-inflationary rate, to be higher. Asset pricing and VAR approaches estimate long-run R bar. I would say that Laubach and Williams get closer to R star. I offer some assessments here by ECB researchers, which also push in this direction, but I'm not going to linger on these, and you can go back and look. Let me turn to some numbers. Um, Here I show three different measures. The red line is a measure of the 5-year forward real rate of interest extracted from uh, uh, the term structure of US Treasury rates. HLW is basically the Laubach-Williams estimates, and that's the orange line. The blue line is a VAR methodology adopted by Lubick and Mathis at the Richmond Federal Reserve. And you can see that these give very different estimates of the natural or the neutral rate. The HLW estimate is the lowest, the Lubick-Mathis is the highest, and the term structure estimate is somewhere in the middle currently. Now, many reasons why R bar and R star could differ. One would be if the central bank's credibility is imperfect. The central bank might have to hike interest rates to a very high level to convince uh, markets, firms, and households that it's serious about getting inflation back to target. Financial conditions are all important. In the US, the fact that many households contracted very long-term mortgages at very low interest rates during the pandemic uh, has weakened, arguably, the impact of monetary policy, which is another way of saying that the neutral rate is higher. Like if you want to have a disinflationary impact, you need a higher policy rate. Most of these methods do not really take into account the fact that the economy is open, which is kind of an amazing fact, and I think would amaze uh, students from small open economies such as Armenia, but it is a fact. Holston, Laubach, and Williams, it's a completely closed economy model. Yet global factors have been all important in determining both R bar and R star, which tend to trend together. This insight, which unfortunately is lost in a lot of the recent literature, the macro literature, was stated very clearly by Charles Kindleberger as early as 1937 in his first book. He was then on the staff of the New York Fed. And what he says is that even if monetary policy is aimed only at domestic variables, even if you only care about domestic inflation and the domestic output gap, it's still the case that it's going to be influenced by external factors. And so external factors cannot be left aside. And a way to see this is through the standard sort of Metzler model of the international capital market. Take two countries, a home country and a foreign country. In each country, saving depends positively on the real rate of interest. Investment depends negatively on the real rate of interest. If each of these economies were closed, then the equilibrium real rate would be where saving and investment are equal. And I label these as the autarky rates of interest with the superscript AUT. The way I've drawn the picture, the home country has the higher autarky rate of interest. What happens when we allow these countries to engage in financial borrowing and lending with each other such that the real rate of interest is equalized between the two economies? Well, the real rate settles at a point that I've labeled R star, which is equal for the two countries. And it's defined by the equality of the home country's deficit, its current account deficit, the excess of its investment over its saving, with the foreign country's surplus, the excess of its saving over its investment. So here, capital flows from foreign to home in a way that equalizes interest rates. But what you'll notice is that any shift in either country's saving or investment schedule will influence real interest rates throughout the world. And so even if you're the United States, um, uh, the R star that will be relevant for US inflation is partially determined abroad. And the US is 1/4 of the world economy, but there's 3/4 of the world economy out there where a lot is going on that could affect where policy should be in the US. Now, this framework is very consistent with what we observe for long run real interest rates. Now, they're not precisely equal because purchasing power parity doesn't hold, but they trend together. And if we look across industrial countries, the downward trend in real interest rates, real long-term and short-term interest rates, but here I show longer-term rates, has been universal. It's also been a factor in emerging markets, although interestingly, in emerging markets, since the global financial crisis, the downward trend in real interest rates stalled until very recently, when certainly for ex-post real rates, the inflation surge drove them to very low levels. But there's some evidence of impediments to capital flows between rich and poor countries, for sure. Okay, so given this framework, there are pitfalls for monetary policy in the use of R star as a guide to monetary policy. Let me just mention a few. Financial conditions are important. I mentioned the U.S. Situation with respect to long-term mortgages, also the fact that many corporations finance themselves long-term during the pandemic. Financial conditions have to be taken into account. Interestingly, if you take the new Keynesian model as your guide, whether policy is restrictive or not depends not just on today's R star, but the whole future path of policy rates. The duration and stringency of your policy matters. I've mentioned the difficulties of large public debts. What about exchange rates? Well, exchange rates do give monetary policy a degree of freedom, but they don't ever fully insulate the economy. And the Metzler diagram I showed you indicates forces that operate regardless of the flexibility of the exchange rate. So R star is not a complete guide, but having a sense of where it is and where it will go in the future is going to be helpful. Okay. What are the main influences on R star? There are many factors, and a partial list would be demographics, productivity growth, inequality, safe asset demand, China's growth, financial deregulation, the formation of the euro. There are a large number of surveys. I recently wrote one in 2023. It's an NBER working paper and a CEPR working paper. So I go into much more detail on these issues. uh, each of these could be a lecture in itself. I mean, really. I've included in the slides a little bit of information on from my paper on what might have driven interest rates over different periods. I don't want to go into detail on this because I do want to leave some time for questions. But what I will say is that in different eras or epochs, different factors have been uh, dominant. And on this slide, which you can come back and look through later, I give a little bit of texture to those statements. What do we think was going on in these different periods, from the 1990s to the Asian crisis, from the Asian to the global financial crisis, and from the global financial crisis to COVID-19. Of course, it's COVID-19, not COVID-10, but that's a typo. Well, post-COVID and with the return of inflation, real rates of interest have risen. And a question everyone asks is, will they stay higher? This has huge implications, particularly for fiscal sustainability. And just as an interesting aside, many are focusing on predicting higher interest rates now for a number of reasons, but this is not the first time that high interest rates have been predicted. Back in 2010, the McKinsey Global Institute did a study called Farewell to Cheap Capital. And they said, we project that by 2020, global investment demand could reach levels not seen since the post-war rebuilding of Europe and Japan. And they predicted correspondingly higher real interest rates. Think of that Metzler diagram. This, of course, did not come to pass. All of the models I showed you have very big bands of uncertainty. But there are many predictions now of higher interest rates going forward into the long term. A book by Charles Goodhart, who you've just heard, and Manoj Pradhan, which was from before COVID, gives a very rich and detailed case for higher interest rates based largely on demographics. Their argument is contested. A recent survey by ECB researchers argues that cyclical measures of R-star for the euro area have been edging higher. And by cyclical measures, they basically mean the neutral rate. Slow-moving estimates are unlikely to have risen. Those estimates would be more akin to the natural rate. And they find relatively small increases in R-star. Holston, Laubach, and Williams are arguing in their most recent estimates that real interest rates, real neutral rates remain low. A recent workshop at the Bank of Japan looked at Japan's economy, also found continuing low natural rates in general, but with a wide spread depending on what model you look at. And I would expect that by now these results have been posted online. Again, I return to this graph which I showed before, showing the divergences among three methodologies. Again, the range is from Holston, Laubach, and Williams below 1% to Lubick and Mathis above 2%. for R star. Uh, Even different methods employed by the same team of researchers can disagree. Here, a team from the New York Fed looked at a VAR model and a DSGE model, and again get very, very different rates, a spread similar to the one I just showed you, with the VAR estimate being below 1 and the DSGE estimate being about 1.75. Of course, we need not look only at the models. We can look at markets. What do markets think is going to happen going forward? And here, if we look at long-term inflation-linked yields at the 10-year horizon, the 30-year horizon, they've moved sharply higher. Again, there's a spread depending on what country you look at. Those in the US are higher at about 2%. Again, of course, an issue with these type of inflation-protected bond yields is that there are liquidity premia, there are term premia. These are the kinds of things that the asset pricing approaches, such as the one I showed you, try to take into account. So, what does economic theory suggest? Well, demographics, to my mind, remain very important, and that was the point that Goodhart and Pradhan made. While I disagree with their specific analysis, I think the demographics are quite important. And one reason I disagree with them is that empirically, the old don't just save much on average. Their point was that, if we have older populations, older people are saving less. There'll be less global saving, and global real interest rates will rise. But actually, that's not the case empirically. The old hold assets, delete bequests to guard against health mishaps, to guard against living too long. Detailed multi-country models, there are a few. There's one by Auclair and co-authors. There are some by Bank of England teams, show real interest rates continuing to decline through much of this century. And the UN predictions for population are that life expectancy will grow on average across the world, and that population growth will turn negative by the mid-2080s. These are predictions that I believe push in the direction of lower long-term rates. And remember, population is probably one of the more easy variables to forecast compared to those we normally try to forecast as economists. Investment will be lower as workforces age, and as population shrinks, the scope for profitable innovation will contract. Chad Jones has written on this. On the other hand, some have pointed to AI, to rising productivity. Daron Acemoglu has tried to throw cold water on the idea that AI will lead to huge productivity gains, but the question is open. Higher military spending and very badly typoed geopolitical fragmentation are issues. Higher military spending, which implies fiscal expansion, could raise interest rates. So could green transition costs. But remember, if fiscal policy turns very expansionary and interest rates remain high, this causes problems for fiscal sustainability. It raises the possibility of debt crises. So on balance, at least for advanced economies, given the demographics, I'm not confident that sustained real high interest rates are going to be the future once the current disinflation is over. If low rates return, there are many policy implications. The problem of the effective lower bound will not go away. And we'll be talking more frequently about proposals like 3% or 4% targets for inflation in advanced economies, maybe even higher in emerging economies, and eliminating cash completely so that it can pay negative yields. On fiscal policy, if interest rates remain low, this is good news for public debt sustainability, but only if low rates remain below growth rates, low interest rates remain below growth rates. Demographic pressures could lead to a deterioration in social insurance and higher precautionary saving if interest rates are higher. So I think there are forces that will tend to limit the likelihood of high interest rates. Again, some driven by demographics in light of the need for fiscal sustainability. And finally, a topic I haven't said much about, but I think is important, is financial stability. If low interest rates uh, lead to persistent reaching for yields, this could threaten financial stability, and it could threaten the business models of banks, pension funds, and insurance companies. So low rates may appear to be a distant prospect in the current environment. Uh, uh, Perhaps rates will be somewhat higher than before COVID, but I don't think we're going to return to the kind of interest rates that we saw in the 1990s or the uh, um, 2000s anytime over the long term in the future. And I guess I'll stop there.